I wasn't going to make this video. Because the internet has a talent for taking a violent 2-day move, slapping a giant number on it, and then selling you the cleanest fairy tale it can find. This person did that. That headline caused this. Case closed. And if you're here because you saw a title like Gold crashes $600 in 48 hours and $7 trillion wiped out, plus a political appointment being blamed as the trigger, I get it. That's a powerful cocktail. It pushes every emotional button at once. Fear, outrage, urgency, and that creeping feeling of, wait, am I missing something? But here's the problem. When markets move fast, the story that spreads the fastest is usually the story that's easiest to say, not the story that's most accurate. So today we're going to do this the right way. Calm, plain English. No worshipping the chart. No villain cosplay. We're going to answer one question: what actually triggers a historic liquidation in gold, and why silver tends to get dragged along, especially when big headlines and policy drama are in the air. And I'm going to make one promise. I'm not going to ask you to believe anything on faith. I'm going to give you a mechanical framework you can use the next time the market tries to make you panic. Quick check-in before we start. Comment one word: leverage or cash. That's it. Because that one word tells me whether you're watching this as entertainment, or whether the rules of the game can force decisions out of you when volatility spikes. Alright, first let's handle the sensational framing, because if we don't, everything else becomes noise. When you see $7 trillion wiped out, that number is often a mashup of different concepts people blend together when they want maximum shock. Notional exposure, market cap math, paper claims, derivative layers. Sometimes it's grounded, sometimes it's a narrative grenade. Either way, the emotional function is the same. It's designed to make you feel like the floor disappeared. So instead of anchoring on the biggest number, let's anchor on the only thing that actually matters in a liquidation event: what turns a normal move into forced selling. Here's the clean definition. One sentence. Put it in your pocket. A crash-style move is a volatility and collateral feedback loop that forces non-consensual selling. Non-consensual selling means people aren't selling because they woke up and changed their mind. They're selling because they have to. Margin calls, risk limits, liquidity gaps, forced de-risking. The market starts selling for them. That's what historic liquidation actually means in the real world, the system flipping from voluntary to forced. Now here's the part that will immediately make you smarter than most commentary you'll see. The trigger in a liquidation is usually not one headline. Headlines are sparks. The explosion happens only if the room is full of gas. And the gas is fragility, crowded positioning, leverage, thin liquidity, and collateral constraints. So the better question is not which headline caused it. The better question is, was the market in a state where a spark could flip the system into forced selling? Because if it was, almost any spark can do it. A policy appointment, a surprise comment, a data print, a sudden risk-off wave, a big fund reducing exposure, something breaking elsewhere that forces cash raising. The spark changes, the structure stays the same. Now, to understand why gold can drop sharply and why silver often gets hit even harder, you need to understand that metals live in layers. Gold is not one market. Silver is not one market. They are ecosystems. There's the physical layer, actual metal, stored and delivered, fabricated and shipped, slow and stubborn. And there's the paper layer, futures, options, leveraged products, synthetic exposure, funds, swaps, ways to own metal without ever touching it, fast and expandable. The price you see on your screen is heavily influenced by the paper layer, especially in the short term. That's not a conspiracy. That's just how modern markets are built. And modern markets have one obsession: collateral. Everything comes back to collateral. So here's the mechanical sequence that creates a historic liquidation. And I'm going to keep it crisp, because this is the engine. Memorize this, and you'll stop getting emotionally hijacked. Price drops. Volatility rises. Collateral demands rise. Forced selling begins. Liquidity thins. Price drops harder. That's it. That's the machine. And the moment that matters, the true trigger, is the switch from I'm choosing to hold to I'm being forced to reduce. Now, how does that switch happen in metals? It usually happens through one of three pathways, sometimes all three at once. Pathway 1, leverage gets exposed. A lot of people own gold and silver through leveraged instruments. Not always crazy leverage, sometimes even modest leverage, but enough that a fast move can trigger collateral stress. When volatility spikes, risk models tighten, margin requirements can rise, brokers demand more collateral, liquidity providers widen spreads. Your cost to hold risk increases. If you can't post the extra collateral, you don't get to argue. You get reduced. Or you get liquidated. So the first pathway is simple. Volatility turns into collateral pressure, and collateral pressure turns into forced selling. Pathway 2, cross-market cash raising. This is the pathway people misunderstand because it feels counterintuitive. Gold is a hedge, sure, but gold is also liquid, and in the first wave of a broader stress event, people sell what they can sell. If a fund is getting hit somewhere else, equities, credit, whatever, and they need cash to meet margin calls, they sell liquid positions. Metals exposure can become the piggy bank they smash to survive. That selling is not a statement about gold's long-term value. It's a statement about needing cash right now. So you can absolutely get a world where fear rises and gold drops, because liquidation is about cash, not logic. Pathway 3, crowded positioning meets thin liquidity. When positioning is one-sided and liquidity thins out, the market becomes crashable. All it takes is one push through a level where stops cluster, and you can get a cascade. Stops trigger, reactions trigger, market makers step back, spreads widen, the move accelerates. Now, where does the political appointment headline fit into this? It fits as a spark. Markets don't just price data, they price expectations. And when a high-profile appointment is perceived rightly or wrongly as a signal about future policy direction, rates, inflation stance, independence, credibility, whatever the narrative becomes, it can change positioning fast. But here's the key: a headline cannot liquidate a market by itself. A headline can only expose fragility that was already there. So if you want the real trigger, don't worship the headline. Check the fragility. That's why in these moments, the most important question is, who got forced? Because forced participants drive the most violent moves. Forced sellers sell into weakness. Forced buyers cover into strength. Both create acceleration. Now let's talk about silver for a second, because silver is where people get especially confused. Gold is often treated like the adult metal, more stable, more institutional, more directly tied to monetary psychology. Silver is the wild cousin. It's part monetary story, part industrial story, and it tends to have more dramatic behavior under stress. It's more sensitive to leverage and to shifts in growth expectations. It can move more violently, both up and down. So in a liquidation event, silver often doesn't just follow gold. It exaggerates gold's move. If gold gets sold because collateral is tight, silver can get hit harder because it's more volatile, which means it triggers collateral tightening faster, which means it produces more forced selling. Same engine, bigger reaction. Now, if you're watching this and thinking, okay, so what are you actually saying happened? I'm saying this: a historic liquidation in metals is usually the result of a structural feedback loop, volatility and collateral, often intensified by cross-market cash needs and thin liquidity. Headlines can be sparks, they are rarely the engine. That's the framework. Now let's make this useful by talking about what happens next, because that's where most people make their worst decisions. After a violent two-day move, there are 3 lanes the market typically takes. And I'm not giving you a prophecy, I'm giving you a map. Lane 1, flush then snapback. This is the classic forced liquidation cycle. The market dumps hard, weak hands get forced out, selling exhausts, and then price snaps back violently because the forced flow is gone, and buyers finally get room. This snapback can be brutal. It makes panic sellers feel foolish, and it traps late shorts. Lane 2, grind lower. No clean bounce, just repeated selling, failed rebounds, elevated volatility. This is the lane that drains confidence and causes slow capitulation. Lane 3, chaotic chop. Wide ranges, sharp reversals, both sides get trapped. This happens when the market is trying to find a new equilibrium while participants keep getting forced in and out. 3 lanes. Now the next question is the only one that matters. How do you know which lane you're in? You watch behavior, not vibes, not influence or certainty. Behavior. Here's the measurable watch list. It's simple, specific, and it keeps you out of trouble. First, follow through. After the crash move, do we make new lows over the next 1 to 2 sessions? If yes, the pressure isn't done. If no, if buyers reclaim ground and hold, it suggests the forced flow may be exhausting. Second, rebound quality. Do rebounds hold for a full session, or do they get sold within hours? In a continuing liquidation regime, rebounds are weak and quickly sold. Third, volatility trend. Is volatility rising as price falls? That's stress building. Or is volatility peaking and compressing while price stabilizes? That's often the first sign the forced selling is getting cleared. Fourth, liquidity fingerprints. Watch for air pockets. Sudden fast drops, big candles, ugly gaps, unusually wide spreads. Repeated air pockets mean thin liquidity, and thin liquidity is where cascades thrive. Fifth, collateral tightening signals. You don't need secret data to notice this. Platforms and brokers tighten leverage, raise requirements, restrict products, widen risk controls. When that happens during high volatility, fragile participants become forced participants. Sixth, paper versus physical divergence. If screen price drops but physical premiums stay firm, availability tightens or delivery times stretch, it can suggest the paper market is doing most of the moving. If physical loosens too, then the move is broader and deeper. Now here's the final warning version of that watch list. 1 line. If you see 2 or more of these at once, quickly sold rebounds, rising volatility, repeated air pockets, tightening collateral, and physical staying tight while paper price drops, you're in a crash-prone regime. That doesn't guarantee a continuation. It tells you the structure is fragile. Now let's talk about the psychological trap that ruins people right here. After a huge move, people want to make it back or catch the next leg. They start trading urgency. They start making all-in decisions. They start treating the market like it owes them a clean explanation. And the market punishes that. So here's a rule I want you to remember, because it protects you in any asset, and metals especially. The market doesn't have to beat your thesis. It only has to beat your margin. That's the reason so many people lose money while being right. They're right, but they're fragile. Fragility is the real enemy. Now I'm going to split this into lanes, because different people need different advice, and mixing it is how you get confused. If you trade paper with leveraged futures, options, leveraged ETFs, your job is to stay unforced. That means you size positions so a violent move doesn't liquidate you. That means you accept that exits get messy when everyone rushes for the door. That means you stop believing in, it can't go lower, or it has to bounce here. In liquidation regimes, those sentences are expensive. If you hold physical, your job is calm. Physical metal is not a scoreboard. It's not supposed to give you adrenaline. If your mood swings with every candle, you're not hedged, you're haunted. Physical is about long-term trust and optionality, not daily validation. If you allocate long-term through any vehicle, your job is process. No chasing parabolic moves. No panic dumping flushes. Scaling, diversification, survivability. Now, since the title talked about historic liquidation, I want to give you one more concept that will make these events make sense. In liquidation events, correlations rise. Assets that should be different start moving together because the driver isn't fundamentals. The driver is forced de-risking and cash. That's why you can see things move in ways that feel wrong. They're not wrong, they're mechanical. That's why the best way to describe a liquidation is this. It's not a vote, it's a margin process. Now I want to address one more thing, because some of you will be thinking it. What if this was engineered? Here's the responsible answer. Markets can be influenced in the short term, especially when liquidity is thin and positioning is crowded. A push at the right time can create a cascade because the system is fragile. But you don't need to prove intent to protect yourself. Your defense doesn't change. Your defense is not being crashable. Which brings me to the most practical part of this entire video. If you want to be immune to historic liquidations, you don't need secret information. You need to stop turning yourself into a forced seller. That means less leverage, less oversized positions, more respect for volatility, more patience, and a plan that doesn't depend on perfect timing. Now, one final comment prompt, and I'm keeping it to one because too many prompts make people tune out. If you had to choose what comes next, snap back or grind, one word, no essays. I want your call in plain English. And here's the final takeaway. In one sentence, the crash wasn't caused by one headline. Headlines are sparks, collateral and leverage are the fuel, and fragility decides whether you get a fire or an explosion. If this helped you, subscribe. I'm going to keep breaking down the plumbing behind big moves without the circus, because understanding mechanics is how you stay alive when everyone else is trading emotion. And share this with one person who's trading leverage like it's a personality trait, not to shame them, to protect them. Educational only, not financial advice. I don't know your situation. Nothing here is a recommendation to buy or sell anything. Manage your risk, make your own decisions, and don't let a headline rent space in your nervous system.